As of late 2025 to early 2026, with the exception of Jane Street, we started seeing major institutions begin to add to their positions in strategy. And given how Bitcoin has been trading, the current war in Iran, and the overall market sentiment, this defensive trade may be for you. On February the 27th, we entered into this trade, coined the Phoenix trade, that expires in 49 days on April the 17th of 2026. Our underlying is MSTR, or strategy. It's currently trading at $130 as of February the 27th. Now, if you don't like strategy, you can always apply this to another underlying, or if you're sitting on the sideline and you want to think about entering a position, maybe you can use this trade in order to get a discount before entering the position. We like you to focus on the following two columns and ignore everything else because we're going to explain it later on. First, it's MSTR's price or strike price by the expiration date. Second, it's the return on capital because we want to see if this trade fits your criteria. Notice in this case, when MSTR is trading up, you have no upside risk. You're always going to make a gain. Now, there is an opportunity cost because at $140, you're going to make a flat 2.83% return. Now, on the other side, when MSTR is trading between 105 to 110, notice you're going to make a flat 5% return. And if it did nothing and stuck around and traded neutrally between 115 and 130, you're going to make the max return of 7%. Now, the crux of this trade is to get you a really good discount prior to committing. You'll notice over here that if you were to enter this trade, your break-even point is actually down at $99.24, representing a 24% discount from the price of $130 currently. Now, if your cost basis is $99.24, that's actually MSTR trading at an MNAV of 0.77, which means that the market is only valuing their shares at 77% of their net asset value, which is mostly Bitcoin. In the previous video, we discussed these three trades in detail. They're going to lay the foundation and help us understand what the Phoenix trade is and how the mechanics actually work. For those of you who didn't watch the last video, please go back to the last video for a more thorough explanation. Moreover, these trades expired on February the 27th of 2026, and we used the options on IBIT in order to act as a proxy for BTC when we carried out these three trades. So let's look at the results of these three trades. So here's the P&L for the trades that we placed over here, and some of them we entered on February the 5th and some on February the 9th, but they all had an expiry on February the 27th, and we're going to quickly review them at the beginning of this video. My name is James from The Value Thinker, and today we're going to talk about two things. First, we're going to review those three trades that we put on and to see how they performed in terms of their P&L after their expiration date. Next, we're going to be looking at the genetic makeup of the Phoenix trade. You would have guessed it, we combined those three strategies in a certain way in order to develop this trade. Firstly, we start off with a foundational cash secured put. Then we layered over that the bear buffer, or what's known as a 1-to-2 put spread ratio in order to give us that deep defense. Lastly, over here, we added the Jade Lizard to essentially allow us to defend ourselves but to gain more credit out of the trade. So if you're ready, let's jump right in. As always, nothing is investment or financial advice. Everything is education and entertainment only. Markets are extremely volatile, so make sure you do your own due diligence and research before entering any position. We have nothing to sell you. There's no Discord group. This is not a sponsored video. The only thing we ask of you is if you find the material helpful, please consider liking the video, subscribing to our channel, and pinging the notification bell. If you're on X, consider giving us a follow because we can tweet out the material faster than producing a video. In the first part over here, we're going to look at the post-mortem of those three trades. All three trades were started on either February the 5th, on the day where Bitcoin had that 18% crash, from 73K down to 60K, or on a boring day like February the 9th. All three trades had an expiration on February the 27th, which is the last Friday of the month, and that's when Bitcoin's notional value of its options market on that Friday expired. While all three trades were profitable, we emphasized that it was the underlying thought process and mechanics that really mattered at the time of entry. Let's quickly review trade number 1, which is the foundational trade for selling a cash secured put. On February the 9th, we entered this trade over here when IBIT was trading at $40 or the equivalent BTC of 70K. This trade is going to expire on February the 27th. We sold out a put option with a strike price of $36 and we collected 75 cents of the premium for taking on this risk as the seller. What this means is that we're obligated to buy the underlying, in this case IBIT, at $36 should the buyer wish to exercise their right anytime from now to essentially February the 27th. To do a return on capital on this trade over here, you'll notice that if we fast forward in time to February the 27th, IBIT stopped at around $37. That means that it's over our strike price of $36, so we end up keeping the premium. In order to do a return on capital, we take the 75 cents divided by the strike price to give us roughly 2%. For those of you who like absolute dollars, you can calculate it by taking $35 divided by $3,600, and that would give you the exact same amount. Why 3,600 on the denominator? Well, you sold one option, which represents 100 shares. You're going to take that 100 shares and multiply it by $36. You also note over here that our break even was at $35.25. And how we got that was taking the $36 strike price, subtracted from our premium of 75 cents to give us that as a break even. And if we had touched that break even, well, that would have represented a 12% drop in the price of IBIT from our entry point. Now, some of you may be looking at this trade and thinking to yourself, but that's only 2%. But remember, in our Master Put Selling course, part 1, we talked about the folks who usually employ this strategy right here. They're looking for a consistent, stable way in order to produce 2 to 4% per month. And while you might not like IBIT as the underlying, you can apply this to anything else. But please note over here that 2% on an annual compounded basis is roughly 26% return per year, which outpaces the S&P 500. You also note that in this trade over here, we put it on for 18 days. If you can essentially return that percentage in 18 days, that would compound out to essentially 49% on an annual basis. So here's the P&L table, and you can already see that anything over $36 and the buyer will not exercise their right. Why? Because why would they sell you a share for $36 when they can sell it in the open market for a higher price? We already noted the break even, and of course, if you were forced to accumulate IBIT in this case over here, it would be equivalent to buying BTC when it's in the high 50s. So we're just going to quickly bring back these two papers over here, starting off with the Goldman Sachs one, which basically says that if you sell these cash secured puts on essentially companies that have a strong free cash flow, meaning that they're companies you're comfortable owning during a downturn, well, it outperformed holding stocks and had a lower volatility, standard deviation, or in other words, risk. So here's a second study by Tasty Live, and you'll see over here that even though they were selling naked puts, it outperformed essentially longing shares, and at the same time, it had a smaller standard deviation or a smaller risk profile to essentially than owning the shares. Going on to our second trade, which is not the second strategy, it was just basically selling a cash secured put but collecting a massive premium on February the 5th when BTC had that large dump from 73K down to 60K. So here's strategy 1B. It is identical to strategy 1, except that we collected a massive premium on February the 5th when BTC was on fire and going into a death spiral from 73K down to 60K. You'll notice over here that when we entered the position, IBIT was trading around $34 and BTC basically around 60K. We collected a massive premium of $2.75 when the market was in total chaos and in fear. We sold out our $35 put option, and again, that obligates us to buy the underlying should the buyer wish to exercise their right for $35 anytime between February the 5th to February the 27th. So fast forward to February the 27th, we all saw that IBIT ended up at $37, which is roughly around 67K BTC equivalent terms. In this case over here, our option expired worthless because IBIT is trading over $35 and we collected the full premium of $2.75. To do a return on capital, we take $2.75, divide by 35, and that gives us a massive 7.8% return within those 18 days. So here's the P&L table for the $35 premium cash secured put. You'll notice over here that anything over $35 and we get to keep the entire $2.75 premium. That translates to a 7.86% return. Remember that no buyer would sell you the IBIT for $35 when they can sell it for higher on the open market. Our break even was at $32.25, and that's the strike price of $35 subtracted from the premium of $275. Now, if we had to accumulate and hold on to BTC, you'll notice over here, that means that we're going to be accumulating around the 54K line and less, and that's a price where we're comfortable holding. So here's strategy number 2, which is the Jade Lizard, and it produced the highest return under these market conditions given the trade mechanics. Strategy number 2 is known as the Jade Lizard. It's considered a skew neutralizing trade. Why skew? Because we're harvesting the rich put premiums due to the intense state of fear that the current market is in. On February 25th, when BTC crashed from 73 down to 60K, which is our entry point when IBIT was trading at around $34. This position expires on February 27th like all the other positions. We're going to build off of the last trade, the cash secured rich premium. In this case, we're going to sell the 35 put option and collect $2.75 again. We're then going to add on to this, and this is where the magic of the Jade Lizard happened, which is selling out a call spread to the upside. In this case, we're selling the spread by shorting the 41 call and buying the 43 call. It gives us a net premium for the spread at around 70 cents. Notice again why it's called skew neutralizing, because in this case, we're at risk for the width of the spread from $41 to $43. That's a risk of $2. But our put premium of $2.75 for selling out that 35 put neutralizes that $2 risk in the width of our spread that we sold out. In this case, the overall premium that we collected, which is basically going to be the $2.75 plus 75 cents, they're giving us a whopping $3.45 of entering this trade. I emphasize that we do not have a risk to the upside because the premium that we collected off of the $2.75 covers the entire width. So if we do the P&L over here, you'll see that we're going to take the $3.45, the total premium, divided by essentially the strike price that we're liable for, which is the 35 put that we sold out, and that gives us a significant 9.86% return. And as we all saw, the February 27th came and the option expired worthless because IBIT was trading at around $37. So here's the P&L table for the Jade Lizard. Notice that anything over $35 and we're collecting quite a rich premium. However, the call spread that we sold out in order to get that extra premium up at $41 to $43 starts on eating into our profit of the $3.45 premium that we collected, ending off with at $43 we can only collect a maximum of 4.14% and any strike prices above that. Our break even over here is very nice. It's around the 55K line, and that means we take $35, subtract it from the premium we collected at $3.45 in order to give us that $31.55 IBIT price of the break even. And anything lower than that, we view it as an accumulation zone. So here's strategy number 3, which is the 1-to-2 put spread ratio or the bear buffer. It doesn't look like it performed well, but this is actually a very effective strategy under bear markets in order to enter positions. Strategy number 3, the bear buffer or the 1-to-2 put spread ratio. For those who watched the last video, you would have remembered that we can break this trade up into 2 simple trades, a cash secured put plus a debit spread. In this case over here, we entered the trade on February the 9th. Nothing exciting was happening. BTC was trading around 70K and IBIT was netting in at $40. We first bought a put option with a strike price of $35 and we paid 50 cents for that. Remember, buying a put option gives us the right to sell the underlying asset, in this case IBIT, to the seller anytime from now to the expiration of February 27th for $35. We turned around and then we sold out 2 $33 put options which paid us 40 cents each. The net credit on this trade when we do the calculation is basically 80 cents minus the 50 cents to give us a net credit of 30 cents. Remember, this trade, we're not going after the net credit. So just as a quick visual reminder over here, you can think about that 1-to-2 put spread ratio as a sum of these 2 individual trades. Remember the debit spread that we talked about by buying the 35 and selling the 33 and paying 10 cents for that debit spread. Then we're going to add this cash secured put over here by selling another $33 put to give us 40 cents. No matter how you do the net credit calculation, on the left side, it's going to be the 80 cents minus the 50 cents. And on the right side of this equation, it's going to be the minus 10 cents plus the 40 cents to give you a net credit of 30 cents. In summary for the bear buffer over here, remember that you're only at risk for one out of those 33 put options that you sold. Why? Because the other one is captured in that debit spread that you had to buy. So now you're only at risk for one of them. The initial return on capital calculation is the 30 cents divided by the $33, generating you a measly 0.9% of a return. This is not the only return you can get in this profile for this trade. The true reason why you put on the bear buffer was to help you get an entry that you were comfortable with. Notice that on February the 9th, we put on the trade when IBIT was at $40. And if you had to take charge of the underlying, your break even is at $30.70, representing a 24% drop in the price of when you entered the trade. So just a quick reminder of where you profit maximize in this trade. You'll notice over here that the put spread ratio, remember that it can be broken up into the debit spread of 35.33 plus a standalone cash secured put option. In this case over here, if IBIT stops at $33, you're going to profit maximize in the following way. The spread from 35 to 33 pays you $2 at a maximum. The $33 put options all expire worthless because no one's going to exercise them. For putting on this trade, you also collect the 30 cents. So your net credit in here is actually $2.30. If you divide that by the $33, which is where you're being pinned for the trade, that's a 7% return. So the bear buffer can actually return you more than that 0.9% that we talked about earlier. The second important thing over here is how do we calculate the break even? Remember that at $33, you're going to start losing money on that second put option, which you're basically naked on. When you get to that second to the $33 option, every single dollar that IBIT goes down, it's going to eat away from the $2.30 maximum premium that you have in your hand as of right now, until a point where if you take $33 minus the $2.30 premium, and that gives you the break even of $30.70. After that break even point, you basically have an unrealized loss on the books should you continue holding BTC. But at 54Ks, a lot of us are very comfortable holding BTC. So here's the P&L table for a bear buffer trade. So anything over $31 and you're going to be making money. You know that the break even over here is a whopping 24% drop from the $40 IBIT price when you entered. It's now $30.70. Anything after that and you're accumulating in a very sweet zone, which we call the accumulation zone. You also know that at $33, we just showed that that's the honey manuka part of this trade, which you'll profit maximize of 7%. So imagine that the market goes down and you're still making money. Now let's apply the Phoenix trade so you can see how the mechanics work. We're going to begin out the Phoenix trade by applying 2 out of the 3 legs in order to help you understand the complex mechanics that's operating underneath this trade. We entered this trade on February the 27th and it has 49 days to expiration on April the 17th. In this case over here, we're going to start out by applying the first leg, which is selling a cash secured put. In this case over here, we sold a put with a strike price of $115 and it paid us $8.22 of a credit for taking on this risk. If we did nothing else, then the break even for this leg of the trade would have been at 106. Next, we're going to apply the bear buffer or the put spread ratio. In this leg over here, we're going to start off by buying a put option with a strike price of $1.10. And what that does is gives us the right, anytime from now to April the 17th, to sell our underlying MSTR shares for essentially $1.10 or $110. Now, the next part of this leg over here is shorting 2 put options at $105. Notice that the total bear buffer trade that we put on pays us $4.10. So the following visual diagram is going to help us understand how those 2 legs are operating. You'll notice over here when we shorted the 115 put, that gave us a credit of $8.22. What that means is the following on the number line. Every time that MSTR goes under 115, we're going to be giving back part of that $8.22 credit that we collected until the 106 line. And when we're at the 106 line, we would have given back the entire $8.22. Anything beyond that, we're going to start losing on this part of the trade. Next over here is the bear buffer or the put spread ratio. Remember, this can be thought about as two individual trades, a debit spread and a standalone cash secured put. Notice over here that let's apply the debit spread. Remember, we're long the 110 put, and that means that when MSTR trades under that, we're going to be gaining on this put that we're long on. We also shorted or sold two of the 105 puts. Now the first 105 put belongs to this debit spread over here. So that means that our profit on this spread is capped at $5, but it also means that we don't have to worry about one of the 105 put that we're short on. Now, there's the second 105 put that we're short. What that means is when MSTR goes under $105, we're going to start losing money on this second 105 put. Now, it's very important you realize why we're doing it in the following manner. The key to this trade, this part of the trade, is because we're layering the bear buffer right underneath the cash secured put. So when the cash secured put loses all of that $8.22 and gets close to its losing zone, it's being protected by the bear buffer, by that debit spread that we're gaining on the bear buffer to bring our break even down. And the last thing you have to be aware of in this case over here is what are your obligations? Well, by expiration, if MSTR is trading under 115, you're going to be assigned MSTR shares at 115. The other leg is one of the 105 put that we shorted. And again, if MSTR is under 105, we're also going to be assigned some stock at 105. Now, let's calculate the break even at this point in time with only two legs. Before I get into that, I must say that a lot of traders out there only apply trades that only have these two legs. So that's also a new idea that we're throwing in there for you. Notice in this case over here, to calculate the break even, based on the two legs, we collected a total credit of $12.32 so far. Here's how we can think about the break even at this point. On the first leg of the 115 put, notice that if you took that and calculated its break even, you're going to take 115 minus 1232, the total credit we collected so far, to give us a break even of 102.68 for this leg of the trade. Next, remember that the bear buffer can be thought of as two individual trades: the debit spread, buying the 110 and shorting the 105, and a standalone cash secured put at 105. In this case over here, if MSTR is trading at 105, our debit spread is going to maximize its gain at $5. So the only thing we have to worry about is the second 105 put that we're short on. So let's calculate what that break even is. So we already used up our total credit so far. So on the second 105 put, we take 105 minus the maximum credit that we got from the debit spread, and that gives us a break even for this leg of $100. Now, at this point in time, if we average those two over there, we're going to get a break even for the overall trade at $101.34. This represents a 22% discount compared to the entry price when MSTR was trading at $130. Now, let's finally add the third leg of the trade over here. So we started out with the cash secured put, collecting $8.22. Then we layered on the bear buffer and collected another $4.10. Now, we're going to add the Jade Lizard, which is a skew neutralizing trade. You'll notice over here, this trade was basically selling a call spread, and we collected $4.20. Notice that we shorted a 130 call, and we longed a 140 call. So our risk there is a spread of $10. Now, we look at the total credit that we collected, summing the three of these premiums over here, we got $16.52. This is larger than that risk from the Jade Lizard. So that's why we have no upside risk in this trade over here. Let's fuse all the three legs into the trade on the following visual diagram. We're going to start off with our cash secured put, shorting the 115 put. Remember that every time that MSTR goes under 115, we're going to be giving back money, eventually giving up that $8.22 credit on this leg of the trade. Now, in order to protect this leg and drive our break-even price even lower, we're going to be applying the bear buffer or the put spread ratio, which can be thought of as two individual trades as we mentioned. It's a debit spread, and essentially you're naked on that other 105 call. Turning our attention to the Jade Lizard over here, remember we have zero upside risk because the $10 width of the Jade Lizard we're not putting at risk because we collected a premium that's bigger than the $10. We're going to short a 130, we're going to long a 140, and if the stock passes 130, we're just going to start giving back some of our premium. In this case over here, when the stock settles between 115 to 130, that's where we're actually going to earn that 7% return. Let's calculate the break even for the overall trade. So notice that we added the Jade Lizard over here. After adding the Jade Lizard and summing the credits, we ended up with $16.52. And remember that this protects us from any upside risk because it's bigger than the $10 spread of the Jade Lizard. We're going to calculate the overall break even by looking at the 115 put and that 105 put that we're short on. Starting off with the 115 put, we're going to take 115 minus the 1652, and that's going to give us a break even on this leg of $98.48. Next, and you've seen it before, is the break even on the bear buffer part of the leg. Remember the debit spread of longing the 110 put and shorting the 105 gives us that extra $5. And this second short on the 105 put, to calculate its break even, we're going to take 105 minus the 5 to give us $100. And if we average this out over here, we remember that you've seen this earlier on, our true break even is now at $99.24. And that means that we're purchasing MSTR at an MNAV of 77%. Meaning that if I can buy Bitcoin at 77% of its price, I'm going to do it right away. So going back to this slide, we remind you that if you don't like MSTR as an underlying, well, you can choose something else. For those of you who've been sitting on the sideline over here, this may be a good strategy for you to dip your feet into the waters before buying it straight out. In this case over here, remember that we looked at where MSTR traded at and of course the return on capital. This trade has no upside risk, but you are capped after $140 and that is your opportunity cost. Between 105 and 110, you're still getting paid a pretty good return and you're going to max out between the 115 to the 130 because of the underlying mechanics. Now, our break even over here is a whopping 24% discount. Remember, giving you an MNAV for MSTR at 77%. We're going to finish off this video by comparing dollar cost averaging to the Phoenix trade. And dollar cost averaging is one of the greatest strategies for entering a position. In this case over here, we're going to stress test a portfolio of 100K at an entry price when MSTR was trading at $130. Notice in the DCA, we're going to deploy the first 50,000 by purchasing about 384 shares at the price of 130. Then the next 50K is going to be deployed when an MSTR is trading at $105. If you average out these two positions over here, you'll notice that your average price is $116.20. If MSTR is currently trading at 105, that means that this portfolio is down roughly 10%. Now, let's put the Phoenix portfolio to the test. We're going to deploy our first 46,000 over here by selling 4 options of shorting the 115 put and also essentially selling out 4 options of the Jade Lizard. Notice in this case why it's 46,000 is because we took the $115 that we're responsible for multiplied by 400 shares because you sold 4 options and that gives us the $46,000 that we deployed. The next part of this deployment over here is another 42,000 when we sell out the put spread ratio or the bear buffer. In this case over here, again, if you took the 105 put that you're responsible for multiplied by 400, that's how you get 42 grand. Now, if you average the two of those positions out, you'll notice when we're at MSTR trading at a price of 105, remember that's kind of the sweet spot for the bear buffer. That's when those two 105 puts expire worthless. In this case, the Phoenix portfolio is up 5% when MSTR is at a price of 105. Before we compare the 100K portfolio at a price of $90 for MSTR, we just want to point out that the DCA approach, should the stock moon, it's going to make giant gains. Now, when the underlying or MSTR in this case falls, the DCA portfolio will suffer, and that's when the Phoenix strategy shines. So you can't have it both ways. If you want to completely hedge out risks, essentially you're not going to get any gain. Remember, it's a risk and reward profile. In this case over here, the DCA approach, the effective cost we saw was $116.20. At a price of $90 for MSTR, we're going to be down 22.5% for this trade. So the psychology here is that you're down in the bottom of the well. And even if you get a huge rally, you're just going to be breaking even. On the Phoenix side, we saw that the break even was $99.24. At a price of $90 for MSTR, we're down 9%. In this case over here, an easy bounce in MSTR, we're going to be back at break even. We should note that the entry price on February the 27th is at $130. For MSTR to be trading at $90, that's a drop of 31%, and the MNAV is now 0.69 as of the date of the calculation. As always, we'd like to thank our community members for joining us in this video. If you found the material helpful, please consider giving this video a like, subscribing to our channel, and pinging the notification bell. We hope that you enjoyed the material on the Phoenix trade, and we wanted to let you know that we're building out the options material on this channel.